The Federal Reserve is expected to announce the first interest rate hike in almost a decade tomorrow. This has major implications for you, your family, and your money. Chief Washington correspondent James Rosen tonight with what you need to know.
Stocks rallied as the Dow Jones Industrial Average, anticipating a modest interest rate hike by the Federal Reserve on Wednesday, posted its biggest gain in more than a week. Analysts describe the Fed's likely increase in lending rates for banks by 0.25 percentage point, the first such hike since 2006, as the most widely anticipated in Fed history, and the opening of the slowest tightening of credit in Fed history.
The Fed has to start somewhere, and it's playing a balancing act, raising rates a little, just to kind of signal that it's on the move, but not too much that would jeopardize the recovery.
In congressional testimony this month, Federal Reserve Chair Janet Yellen explained to lawmakers both why the policy arm of the nation's central bank, the Federal Open Market Committee, or FOMC, is acting now and why it is acting cautiously.
Such an abrupt tightening would risk disrupting financial markets and perhaps even inadvertently push the economy into a recession. Holding the federal funds rate at its current level for too long could also encourage excessive risk-taking and thus undermine financial stability.
Some analysts suggested that the incremental, crab-like nature of the Fed's expected move fails to convey great confidence in the U.S. economy. Indeed, may signal how fragile the Fed sees the economy as being, even this long into the recovery, with wages stagnant and labor participation low.
This is necessary to actually provide some calming to the market and to provide some reassurance that there's some fundamental strength in this economy. Now, I don't think it's strong, but I don't think it's going to, to sink into the bottom of the sea.
The White House intimated that a tightening of interest rates is due, given modest annualized growth in real GDP of about 2.25% and an unemployment rate that has held steady at around 5%.
If you look at essentially the basics of our economy, whether that's job creation or consumer confidence or economic growth, the economy is stronger than it's been in quite some time.
For ordinary Americans, borrowing money will likely become slightly more expensive. The hope on the part of the Fed is that that will help drive our low inflation rate upwards to its 2% target, but not beyond that. Bret?
James, thank you.